What's going on, everyone? Good to see you back here again today for some stock compensation questions. This is a situation where maybe you're working for a startup or maybe you're working for a well-established company. Either way, the company decides to pay you in stock, maybe in place of or in addition to a normal cash salary. And let's see what questions could take place here. On which date does this measurement take place? All right, well, let's see what kind of measurement we're talking about. For a public entity, the entity is required to measure the cost of its employee services, so this is what you do for the company, in exchange for the award of equity interests, the stock, based on the fair market value of the award. Now we've got a couple dates here. Some of them are important for different purposes. Let's look at our chart and also recollect yourself. Why are these dates important and what happens on each date? Now the grant date is determined by the company. This is when the company says, hey, you're a great employee. Let me give you some stock options. Awesome, thanks. Now, just like a 401k where you need to vest your employer match, you have a vesting period which ends at the vesting date. The vesting date is also determined by the employer. They say, all right, you need to work for us for 10 years, and then all of those stock options will be yours. You can do with them what you will, and what you do with them is on the exercise date. This is determined by you. This is when you decide to exercise the options and sell the stock and essentially earn your extra reward. Now, keep in mind this exercise date could also be the same as the vesting date. It's entirely up to you when you exercise the options. Now, when do you determine the fair market value of that compensation on the company's side? Well, that is not going to be the vesting date. The vesting date is important for the employee. The lapse date is not listed here. It's also not important. That's when the options would essentially cease to exist. They lapse, they are not exercised. We're not really going to talk about that much here in our section. How about the exercise date? Well, that one would make a little more sense than the other two. However, it's going to be the grant date, and here's why. The exercise date could be really any time, right? That's up to the employee, and that would be kind of difficult for the company to track that for every employee and when they decide to exercise it. It could be in 3 years from now. It could be 10 years from now. Whenever it is, that's going to be incredibly hard to document for your financials. So the company is going to measure their stock, essentially just go on Google and say, what is the fair value of our stock? How many shares did we give to this employee? And that's all on the grant date. So they can account for it in their financial statements and give the investors and creditors what they want to see in the financials. All right, let's move on to the next one. Got a little math here. Let's see, possibly. All right. On January 1, year one, the board of directors of a corporation granted, so that's our grant date, 10,000 stock options to the CEO. Each option permits the purchase of one share of stock at $25 per share. I'm going to pause there for a second. Keep in mind, so a stock option, just like an option in the stock market, like a put or a call, is a piece of paper that lets you do something. Now, each one piece of paper allows you to purchase one share of stock. This could be different. It could say one stock option lets you purchase 5 shares of stock. That's just another trick they might throw at you in which you'd have to add an extra number in there and multiply and figure it out. All right, so the current market price of a share is $25 per share. Sounds good there. The options are exercisable on December 31st, year 4, as long as the CEO is still employed. Well, that sounds like a vesting date to me. The options expire on December 31, year 5. All right, well, that seems to be the lapse date. And the grant date fair value of each option is $5. The corporation must recognize what? Let's think this through. Now, what did we just talk about in the prior question? This is building on that. This is compensation expense. That's not really in doubt, right? They're all compensation expenses for the answers. Now, do we do it for 5 years? Do we do it for 4 years? What's the dollar amount? Now here, we're going to use, remember, we're going to use the grant date. The grant date is what's important for the company because the exercise date, that could be quite farther away in the future, right? And that's not fair to the company because they're not going to be able to record something accurately if it happens so much further in the future. So the fair value of each option is $5. Okay, awesome. And what's the cost to the company here? The cost to the company is essentially $5 times 10,000 stock options because it's one share of stock per option. All right, so that's a total cost of $50,000. Now, as you'll notice, all of these answers essentially come out to $50,000. So that's 5 years over 10, 4 years times 12,500, and these are just 50,000. Now, what's the treatment here? Let's think about that for a second. Immediately, all in year one, that is not going to be the case. It's not immediate because we're doing accrual-based accounting. And think about it like this. Over what period is that earned? Well, in the case of the employee, the CEO, that's going to be over 4 years, year 1, 2, 3, and 4. The exercise date is at the end of year 4. So simply put, we are going to exercise 50,000 over 4 years. 50,000 divided by 4 is 12,500. And our final answer here is going to be letter B. Another great question on stock compensation for you all. Hope you enjoyed, and I'll see you in the next one. Keep going strong, you all.